looked at historical stock returns and volatility in our last lesson. In this lecture, we'll explore risk, expected returns, and the concept of diversification to answer an investment advisor's favorite question. Do you want to eat well, or do you want to sleep well? What in the world does that mean? Let me illustrate by offering to play two coin flipping games with you. They're the same except for the prizes. To keep your attention, I'm going to charge you to play these games. We'll talk about how much you have to pay in a moment. In the first game, I flip a coin one time. Heads, you get $1,000. Tails, you get $1,000. That's right, you get $1,000 no matter what. That may be boring, but another name for boring is safe. In the second game, I flip the same coin one time, just like in the first game, but this time the payoffs are different. Heads, you get $2,000. Tails, you get nothing. Because half the time you get $2,000 and half the time you get nothing, your expected payoff, if you play a few times, is the same $1,000 per clip as it is in the first game. Each individual time you play, though, you either double your money or get nothing and lose the amount you paid to play. That's not boring. That's really risky. So, how much will you pay to play these games? It depends on whether you like to eat well or sleep well. If you're like most people, then you'd pay as much as $1,000 to play the safe game. At the cost of $1,000, you get all of your money back immediately. It's perfectly safe. The second game, though, is anything but safe. On average, half of the time you win $1,000 and half of the time you lose $1,000. If you're like most people, then you won't pay as much to play this game. You'll discount your bid because you don't like that uncertain payoff. You might pay, let's say, $800 for a very risky expected payoff of $1,000, but you won't pay the full $1,000. If you're willing to pay $800 but not a dime more, then you're saying that an expected profit of $200 is just enough to entice you to take the risk. We've just illustrated one of the most important traits of financial markets. You can play safe, or you can try for big returns. Sure, you can take something in between, but you can't have both safety and big returns. That's because competition won't let you have both. Suppose that you decided to lower your bid for the first game to just $900, thus guaranteeing yourself a $100 profit after you collect your winnings of $1,000. That would be a great deal, wouldn't it? I see two problems with that strategy, though. First, although it's a great deal for you, I am absolutely not taking your new lower offer. Why would I play if I'm guaranteed to lose $100? The second reason your strategy won't work is that even if I have to play the game, I don't have to play it with you. If I offer to play with a couple dozen people, then somebody's going to offer me right around $1,000 for that guaranteed $1,000 payoff. Competition will protect me from having to take a bad deal. We need to make a very important distinction when we think about risk. There's a difference between a bad deal and a good deal that turned out badly. We don't always get what we expect, do we? Let's return to that risky coin flip. And this time, we'll invite your friend Lisa to play too. I'll play you first, then I'll play Lisa. Let's say that you and Lisa both agree to pay $800 for the game that pays $2,000 for heads and nothing for tails. That's important. Both you and Lisa have exactly the same deals. You see where we're going with this, don't you? If you both have exactly the same deals, then setting aside issues like whether she likes to gamble and you don't, this can't be a bad deal for one of you and a good deal for the other one. It's the same deal. You know what's coming next. One of you is going to lose the game, and one of you is going to win.